Hi, welcome back. In this section, we're going to talk about some of the problems that we have with the debt money system. And I think that we could just say, look where we are today. And if where we are today is a result of the debt money system, there isn't really much more that needs to be said. But having established in the beginning that this is our money system and that talked about how the money system is working in this country today, I would say that one of the major problems that we have in the money system is that it's being operated for the benefit of the private bankers. That is a problem. It's not being operated for the benefit of the people of the United States of America. But if we look at how the private bankers have set up the debt money system, the fractional reserve system, we've talked about the fact that all money is lent into existence. All money comes into existence as a debt, and it is inherent in such an unscientific, I'm going to call it, type of a money system that we get into the problems that we have today. I want to just take a minute to try to get people to think about the debt money system and the problems of the debt money system in this way. We create money strictly on the basis of making loans. When we make loans, we make obligations to pay back the loans. And that means that we have to pay it back with interest. And if all money is created as a loan, if all money is created as a debt, then where does the money come from in order to repay the interest on the loans? Where does the money come from to basically repay in full the obligation that is created when a loan is made? If you think about that for a minute, it basically describes the nature of the problem of debt money, and that is that there is no means in the system to create the payment that it must be made in the future. So therefore, in the future, we must take out of the money that's going to be created in the future those payments. So think about that. If we have a system where every year the only thing that we do is create money as a debt for a loan on an asset, and then we have to have the money to repay with interest, we have a shortfall of money. That shortfall must be made up in future years by taking the money that was created for a loan and use it to repay the interest that was made for the loan that was made in previous years. Now, you would think that the guys that are walking down Wall Street and kicking the rock down the road would be saying to themselves, wait a minute, what's going to happen when all of this stuff starts to catch up with itself? But in fact, they're very comfortable with it because they know the answer. The answer to them is this, and the problem for us is this. When they make that loan and they create an obligation on behalf of the borrower to repay the principal and the interest, they also take a security instrument ownership of whatever it is the money's being lent for. So that if in the future there's any problem with repaying any loan within the money system, the banks have the right to take the assets against which the loans were made. So what do we call those types of those phases of the economy? We call them the booms and the busts. We call them the growths and the declines. We call them the increases and the decreases in the money system. We call it the business cycle, if you will. And there's a kind of a false belief that a business cycle, a cycle of expansion and contraction, are natural things that happen, when in fact they're not natural at all. The money system doesn't need to work in a way that it has to first provide funds for things that people need and then have to take funds back so that people lose things. So we've been existing with the debt money system supposedly to solve the problems that were created without having a central bank and the fractional reserve system. But all we've done is created bubble and bust and bubble and bust. And in the bubble, assets are created along with debts, and in the bust, the debts are reduced and the assets go back to the banks that lent the money. So if you see the reason that a lot of bankers are not so unhappy today, if they're going to be among the ones that are going to make it, they're going to get, they know that they're going to get the assets that they lent the money on back, and they're going to be made whole. And when you take the fact that we are on top of that, you know, providing them with additional money, that goes to show you that there is something wrong with this system. Now, ultimately, we get to the point where we are today, and that is to say, where we've created so much debt with the debt money system that we cannot create any more new money fast enough in order to keep the payments up on the money that's already out there. Though that is basically the nature of the problem that we have today. I would suggest that any listener and any reader take a look at Stephen LaChance, which is spelled just like it sounds, paper called How Debt Money Goes Broke. And in that paper, Stephen lays out the fact that we are today like the dog that was chasing the truck and caught up with it. And that is to say, we cannot, we've issued so much debt, we cannot repay it, and we need to do something. And he suggests we either need a new money system or we need the government to get out of the way of money, which is basically for us to give up the rights that we have to own our money system. So we either need a new money system or we need to give our money system over to the private bankers. And I would say that our solution has to be a new money system. And we're going to start to talk about the idea of a different money system, which has been around for a long time in this country, and how we might achieve that different money system in the next segment. And when we talk about the fact that all money is created as a debt and all money is loaned into origination, and we never create the interest to make the payments of interest, we have to look at it within the context of how that results. What's the result of that? We create an obligation where, let's say on average, money is created over a 25-year term. And that is to say, most money comes into existence on the basis of a 25-year term. It's lent into existence. Our historic interest rates have been an average of 6%. So we have an average 25-year length of money being created at 6% interest. And if you do the math on that, what it really says is that the interest payments are approximately twice the original principal. So if you take that into account, the result of that is this. For every bridge we build, for every school we build, for every item of inventory that we buy and add to inventory, for that matter, for every bag of groceries that we buy, we pay for them 3 times over. We pay once for what's in the bag of groceries and twice for the privilege of using the money system of the private bankers. And that in itself lays the foundation for the problems of the money system. We do not have enough money in the money system to pay for the things that we create. We must continue to create more debt in the future, and that's why we're in the situation that we're in now, where in the contraction phase, households have obviously pulled back in terms of their borrowings. Corporations and businesses have pulled back in terms of their borrowings. And we're not generating enough capital, new debt money. So we have the government stepping in on a regular basis to add another $1 trillion into the economy so that they can maintain the level of payments that are needed. When you think about that, that is the definition of an insolvent and broken money system. And that's the money system that we have today. That's the crisis that we have today. The crisis that we have today is the failure of the debt money system to have work on a sustainable, payable basis. And now we're going to talk about how we've been able to think in terms of creating a new money system and how a new money system might work and a different money system might work.